Committee will come to order. This morning, the Joint Economic Committee welcomes the Chairman of the Board of Governors of the Federal Reserve, Alan Greenspan, who will be testifying on monetary policy and the economic outlook. Today's session is an important part of the committee's review and evaluation of the 1991 economic report of the President as required by the Employment Act of 1946. The most recent data suggests that the nation's economy is continuing to sink deeper into recession. Last Friday, the committee received the annual monthly unemployment figures from the Bureau of Labor Statistics. The unemployment rate rose to 6.5% in February from 6.2% the previous month. That's the highest one-month jump in about 4.5 years. More than 8.1 million people are unemployed, and another 6 million, we received testimony last week, are working part-time because they cannot find full-time jobs. Payroll employment has declined by an average of 200,000 per month since September, 1 million jobs lost in 5 months' time, and the recession is now spread more broadly through the country. During the past year, unemployment increased 45% in New England, 43% in the South Atlantic, 40% on the West Coast, more than 20% in the Midwest. The conventional wisdom, of course, is that the recession will be short and shallow. Each day there's increasing concern, at least on the part of some of us, that the new information indicates the economy is not listening to the conventional wisdom. Unemployment keeps rising. We have a problem with the credit crunch, with banks lending money. Housing starts are at their 4th lowest level in the post-war period. Even productivity is down, and the leading indicators are down. Many think that it is time for the Federal Reserve to be more aggressive in easing monetary policy. During the past 2 months, as the economy has slid deeper into recession, the Federal Reserve has waited until the release of disappointing unemployment data to reduce interest rates, the last example being the Fed's lowering of the federal funds rate by 1/4 percentage point this past Friday after the jump in unemployment from 6.2 to 6.5% had been announced. At a time when the risks could move us into the downside, a deeper and longer recession, it is incumbent upon the Federal Reserve to take corrective action before and not after the bad news. The Fed's recent easing has been welcome, but the cost of this recession and lost jobs, lost incomes, lost production, and the increasing budget deficit should give the Fed all the reason it needs to lower interest rates even more, contribute to ending the recession before it gets worse. Mr. Chairman, we're pleased to welcome you here this morning. You and your colleagues on the Federal Reserve have a difficult job. Obviously, fiscal policy is constrained in terms of applying it because of the very large deficits we've run in the past and the need to address them. The budget agreement, which was reached last fall, which was a part of a package with monetary policy, as it was understood and certainly asserted at the time. We're having even a difficult job getting enough administrative money to get the unemployment claims paid on anything that is reasonable time. So we're pleased to have you here this morning. We're looking forward to your testimony and the opportunity for a discussion and a dialogue. And I'll now yield to other members of the committee for any opening remarks they may wish to make, and then we'll turn to the chairman for his testimony. Chairman Army.
Mr. Chairman, thank you for yielding. Let me just simply say, Mr. Greenspan, it is a pleasure to once again see you this morning, and I look forward to your testimony, and I'll be happy to yield to Mr. Smith.
Thank you. Again, welcome, Mr. Greenspan. I do have some questions, and I do have an opening. I'll wait for your testimony, and I do have an opening statement. Ask unanimous consent to be placed in the record, Mr. Chairman.
Without objection, so ordered. Thank you. Congresswoman Snow, did you have any opening?
No, I don't have a statement, Mr. Chairman. I do want to welcome our witness here this morning. Thank you.
Well, Mr. Chairman, we're happy to have you here. We'd be pleased to hear from you.
Thank you very much, Mr. Chairman. I have a rather long statement which I would appreciate being included in the record, and I will excerpt from it.
We will include the full statement in the record.
Thank you. Mr. Chairman and members of the committee, as always, I am pleased to have the opportunity to appear before you. As you know, the Federal Reserve Semi-Annual Monetary Policy Report and testimony were submitted to the Congress last month. Rather than take you through the details of that report this morning, I would like to focus on a few of the most critical considerations affecting the outlook for the economy and the formulation of monetary and fiscal policies. The recently available readings on business activity indicate that the economic contraction that began during the latter part of 1990 continued through February. The economic data of the past few weeks also included further indications of reduced cost pressures on prices and provided scope for a further easing of monetary policy last Friday. The combination of lower interest rates, the reduction in oil prices, and the resolution of the situation in the Gulf continue on balance to suggest an upturn in real activity later this year, in line with the central tendency forecast of the FOMC members and other Reserve Bank presidents that we presented to the Congress a month ago. In discussing those projections, we stressed the extent to which uncertainties associated both with the situation in the Gulf and with a number of unresolved problems in the economy made the outlook unusually difficult to assess. To a somewhat lesser extent, that is still the case. Certainly, the successful end of the hostilities in the Gulf has removed a troublesome uncertainty and should provide some lift to consumer and business confidence. But the other factors that we noted earlier, concerns about credit availability and problems in real estate markets, continue to restrain activity and to weigh importantly on business thinking. The restraint on credit availability at depository institutions represents a continuing clear risk to the outlook and therefore is a critical challenge for policy. To date, our assessment is that reduced demand for credit stemming from the decline in real activity accounts for most of the recent weakness in bank lending. Nonetheless, developments on the supply side also have had a noticeable effect. Several factors underline the tightening in bank lending practices. Given the uncertain economic environment, banks are appropriately taking a closer look at prospective borrowers in some specific industries. But what is of most concern to us is restraint on lending by commercial bankers to otherwise creditworthy customers. For borrowers whose riskiness has been essentially unaffected by the recession or by developments in specific markets, the reluctance of banks to lend seems to arise from attempts to bolster capital positions. In some cases, loan losses and pressures on capital may be exacerbated by the degree to which examination standards are forcing loans to be written down inappropriately or by market reaction to aggregated data on problem credits on certain categories of loans. Available information indicates that the majority of those who have been turned away or who have been discouraged from borrowing at depository institutions have been able to find financing elsewhere. But one must assume that the alternatives, when they exist, are only available at a higher price. How much production has been lost as a result of sound projects cut back or unable to go forward because of a rise in financing costs or because of an actual or feared lack of financing is difficult to assess. A number of steps have been taken by the Federal Reserve that should relieve constraints on credit supplies. These include lowering interest rates, reducing reserve requirements, and working with other depository supervisory agencies to identify and correct practices that may be unnecessarily discouraging the flow of funds to creditworthy borrowers. Taken together, these steps may well prove sufficient to foster the growth of credit needed to finance economic expansion. But we recognize the risk that problems in this area could persist and could warrant further actions. Another clear negative in the outlook remains the real estate sector, whose problems have exacerbated the difficulties of financial institutions. In the commercial sector, the overhang of vacant space is still substantial, implying that further declines in new construction will probably occur even during a period of renewed economic growth. It would be most unwise to ignore the possibility that these negative factors could cause the contraction in economic activity to last longer or be more serious than is currently anticipated. Nonetheless, a number of elements appear to be moving into place that should enhance prospects for recovery. On balance, when these positive forces are weighed against the negatives, the scales appear to tip slightly in favor of suggesting that the current downturn might well prove milder than most of the recessions in the past 40 years. One important factor on the positive side of the outlook is the sharp drop in petroleum prices that accompanied the onset of the war in the Gulf. While the secondary effects of the cutbacks in employment and income are still running their course, the relief from lower energy prices, along with the apparent upturn in confidence from the end of the Gulf War, should be laying the groundwork for some firming in consumer spending in coming months. Indeed, in the days following the termination of hostilities, the anecdotal reports of increased traffic in real estate offices and auto showrooms raise the possibility that stronger consumer demand may be emerging. But I would caution that such early signals can be quite difficult to read, particularly at this time of the year when activity in some sectors picks up seasonally. Another important influence that is expected to provide support for economic activity as the year progresses is a decline in interest rates, which began more than a year and a half ago, but was especially sharp in the past several months. Since late October, the Federal Reserve has moved aggressively in a series of actions to ease money market conditions. The substantial drop in short-term market rates has been accompanied by a net decline in long-term rates as well. In particular, fixed-rate mortgage interest rates are close to their lowest level since the late 1970s, and the resulting improvement in the affordability of single-family housing eventually should show through in a pickup in sales and home building. Other sectors also are expected to respond to lower financing costs as the year progresses. Since the onset of the recession last year, the areas of greatest concern in the economy have been those related to domestic spending, for which the drop-off has been most pronounced. Nonetheless, it is also important to consider how domestic production has been affected by the trends in exports and imports in recent months, and to assess prospects for sustained stimulus from net exports. In the 6 months prior to the downturn, manufacturing production was rising at about a 2.5% annual rate, boosted considerably by a recovery in motor vehicle assemblies and relatively robust domestic demand for business equipment and industrial materials. At the same time, export demand was providing little impetus to manufacturing production. The slowdown in exports of industrial goods marked a sharp departure from the trend over the preceding 4 years, when the share of exports in our factory output rose 5 percentage points to 13.75%. However, since the peak in industrial production last September, the situation has reversed. Between last September and this January, there was a resumption of growth in foreign demand for U.S. manufactured goods and a reduction in domestic demand for imported manufactured products and materials, including oil. These developments have cushioned the steep declines that have occurred as production has responded unusually promptly to the weakness in the domestic economy. The brisk expansion in non-agricultural merchandise exports late last year occurred in a variety of industrial supplies and materials, as well as in consumer goods and in many types of capital equipment. This increase in export growth came despite a weakening of activity in several of our key markets abroad, and it undoubtedly reflected the gains in U.S. international price competitiveness that had been building for some time. As a result of the decline in the foreign exchange value of the dollar and only moderate increases in U.S. export prices, the average price of U.S. exports measured in foreign currencies has fallen nearly 15% since mid-1989. At the same time, the prices of goods produced abroad have been rising. In the past, such gains in U.S. price competitiveness have led to significant growth in our exports, and if the recent improvement is sustained, continued expansion of U.S. exports would seem to be on track. Even if growth abroad were to slow somewhat, an increasing share of foreign markets would provide considerable support for our exports. Of course, the prospects for sustained strong growth in our exports of goods and services depend importantly on the outlook for economic activity among our trading partners as well. As you know, Canada and the United States and the United Kingdom both moved into recession in 1990, and signs of a turnaround are not yet evident in either case. In contrast to the weakness in those two countries, activity remains vigorous in Germany owing to the stimulus of reunification. In Japan, despite some indications of a moderation in economic growth, prospects for a continued expansion are still favorable. On balance, it is quite possible that growth among our major industrial trading partners will strengthen somewhat later this year, particularly if those countries experiencing recession start to recover. The Gulf War has been overshadowing developments elsewhere, particularly in Europe and in the sphere of international trade negotiations. As the Western European economies move closer to the 1992 single internal market, they will benefit from structural adjustment and increased competition. A stronger, more vibrant European economy in the long run will be a more vigorous trading partner for the U.S. economy. In addition, progress in the historic transformation of the economies of Eastern Europe can be expected to lead to new opportunities for U.S. producers. The focus of our export prospects highlights the importance of a successful conclusion to the Uruguay round of trade negotiations. If those negotiations were to fail, we all would lose opportunities to strengthen trade flows and realize efficiencies that could enhance standards of living worldwide. Taken together, the favorable factors at work abroad and the stimulative forces in train in the domestic economy suggest the likelihood of a pickup in aggregate demand over coming months. And with inventories relatively lean and most businesses, a recovery in demand should show through fairly promptly in a higher level of production. Mr. Chairman, our monetary policy objective for 1991 is to promote economic recovery and to sustain growth at a rate that is consistent with progress over time toward price stability. Whether further adjustments to policy will be required to foster an upturn in output and employment is not yet clear. Any decision in that regard will depend on how trends in real activity, inflation, and the monetary aggregates unfold. Until clear signals of a recovery in economic activity emerge, fiscal policymakers are likely to remain under persistent pressure to take actions to offset other contractionary forces. Concerns about the appropriateness of maintaining a policy of fiscal restraint during a period of weak economic performance are understandable. However, they must be balanced against the benefits that will flow from adhering to a budget strategy that is geared to the longer-run needs of the economy. Those needs can best be met by keeping the underlying or structural deficit firmly on a downward path, even as the actual deficit is being swollen temporarily by the effects of a weak economy. That path promises to improve prospects for increased capital accumulation and higher productivity. It will complement monetary policy in the attainment of the nation's overall economic objectives for the longer run. Thank you, Mr. Chairman.
Thank you very much, Mr. Chairman. In view of the number of members are here, I think we'll go to a 5-minute round, then we can have a second round. Mr. Chairman, on page 4 of, page 5 of your statement, you say it would, having reviewed some of the factors of concern, you say it would be most unwise to ignore the possibility that all or some combination of these negative factors could cause the contraction in economic activity to last longer or be more serious than is currently anticipated. And I was curious, of the downside risks with respect to the economic outlook, which give you the most concern?
I would say those in the financial area, those which many commentators have described as financial fragility. That is, what we are getting is balance sheet pressures on the economy, which are relatively rare, and we don't have a great deal of evidence of how they work their way through the economy. But I think they are of sufficient concern, not only with respect to the financial part, which everyone is discussing, but we also, of course, have, as I noted, a significant overhang of a lot of physical items as well in the balance sheet, commercial real estate, some residential structures, perhaps, but it's not clear, motor vehicles.
We had testimony. Most of the forecasts for a relatively short and shallow recession assume a strong export growth as they analyze the economic sectors. There's considerable concern, and you've alluded to it in your testimony this morning, that the world may be going into a recession, that all of the major trading nations may be moving into a downturn. Jeffrey Moore testified before the committee last week, the director of the Columbia University Center on International Business Cycle Research, and testified that his international leading indicators suggest that many of our trading partners appear to be either in a recession or going into a recession. Now, if that's true, I think reasonable to assume it will hurt U.S. exports, may offset much of the benefit of the declining dollar. To what extent does the Fed's forecast of the economy depend on the assumption of strong export growth?
It depends in part, Mr. Chairman, but obviously the far more relevant part are those domestic elements, very specifically consumer expenditures and domestic capital investment. Obviously, if exports were to tail off very considerably, it would put some downward pressure on the economy, but even though exports have climbed to a very significant part of our economy from a rather negligible part 5-10 years ago, it's still relatively small, and it would require a fairly pronounced contraction in exports to have a major effect on domestic activity, in the sense that it in and of itself would turn us down. That would be very difficult to conceive.
Do you agree with the observation that the international economy may be moving into a recession?
I do not, and the results of the work of our staff, which is fairly extensive in some considerable detail on most of the major economies of the world, does not square with Jeffrey Moore's leading indicators at this stage. And I think eventually we will find out which of the two procedures work out, but I would say at this point, I think there's enough support in the world economy to suggest that a recession is not the most reasonable forecast.
Now, then is your, in effect, lack of concern about this factor as contributing to a downturn in this country premised more on your perception that there will not be an international recession and therefore we will experience the impact of that, or that even if there is an international recession, it won't have a significant impact on this country?
Well, first let me say, Mr. Chairman, that when we're in a period such as this, when the economies are in flux and in several of the major countries, significant recessions are underway, lots of things, accidents and the like, can happen which are utterly unforecastable. And I would be most cautious in making definitive forecasts. I think that what we try to do is to evaluate not only the most likely outcome, but try to seriously think through what can go wrong with the forecast and what type of policy responses might or might not be required should that occur. All I can say to you at this stage is it is certainly the case that we have been revising down, as have others, in a somewhat progressive way in the last 6 months or more, are various forecasts around the world. They have come down marginally, but the best judgment that our staff can make and a number of other analysts in the international arena, OECD, Bank for International Settlements, and so forth, is that the probability of recession at this particular stage on a worldwide interactive basis is certainly less than 50-50.
In his testimony before this committee, Roger Brenner of DRI made a case for a 1 percentage point cut in the federal funds rate. And let me read you what he said, and then I want to ask you to comment on it. You perhaps have already had a chance to examine it. He said the federal funds and short-term Treasury bill rate should be cut another full percentage point immediately. Stated another way, the Fed should buy catastrophic economic insurance. It needs to lessen the risk tied to a scared consumer, a stressed banking system, and a depressed construction industry. If the economy is sicker than assumed and the Fed does not act, the business and employment losses will be severe. If the economy is basically healthy and rebounds strongly with greater Fed help this summer, the only cost of generous policy would be a trivially higher inflation for the next few years. In other words, this insurance is a good buy. Is it?
I don't want to comment on a specific policy action on a specific trade-off. I'm a little puzzled, I must say, because DRI is, in a sense, forecasting a rather early upturn, and in a certain sense, reading their stuff, they're somewhat more optimistic about the near-term outlook than I am. They have got in their control forecast with the federal funds rate averaging, for example, in the second quarter, a little over 6%. They've got the economy small positive in the second quarter and growing at 4.1% in the third quarter and 3.3% in the fourth quarter, if I read it correctly. Now, if I understand what Roger Brenner is saying, is that that is a forecast which requires additional impetus at this particular stage. As a constructor of models over the years myself, I'm really quite hesitant to use a modular simulation to get a judgment as to what's going to happen on models which we all know have not worked all that well over the years. Roger Brenner is a first-rate economist, and he is as good an econometrician as I know, but I don't know of any way in which you can create a forecast the way we are forced to by, as we say in econometrics, changing the add factors on our equations, which is suggestive of the fact that we don't trust the numbers all that well, and then use the model to simulate and have very great confidence in the way the result comes out. So in my judgment, I would be very careful in making assumptions about what type of responses occur to very large changes in monetary policy. In the past, we've found that because of the long leads that occur with policy, that we're often moving to respond to current events and find that when the policy force takes hold, that things have changed. And I think it's a very tough trade-off. I mean, I don't wish to say that it's not something that should be studied. Obviously, we study that stuff all the time, but I would be very cautious in how one looks at various different trade-offs, and I think it's important for us to be aware of the fact not only of the short-term consequences of our actions, but most importantly, the longer term.
Well, my time has expired. I may come back to it. I just observed that in his testimony, Brenner was in effect trying to get, as he terms it, an insurance policy against catastrophic economic developments, and his view was that you wouldn't pay much of a price for it,
Yeah, I'm not sure.
the movements on the price front, and that you would guard against or contribute to guarding against the high costs of a deepening downturn. But
If I may just take a second to respond. I mean, it's obviously a very crucial policy question, because if you have a policy which you're sure the cost of a mistake is minimal, it's the type of policy you ought to try to embark upon. Indeed, I would say a very goodly part of our policies rest on our evaluation of what is the cost if we're wrong. And I think that Roger Brenner is raising the right question. In other words, what is the basic trade-off? I felt comfortable with the type of econometric evaluation that is involved there, I perhaps could agree with him, but I must tell you that I'm much more cautious about what one can realistically obtain from modular simulations. And the whole policy question surrounding how one comes at that issue really is at the root of policy formulation. And I don't want to take too much time, but it's in periods such as this that one often makes major policy mistakes in both directions, and I think we have to be very cautious.
Congressman Norman.
Thank you, Chairman Sarbanes. Mr. Chairman, I can't resist making the observation that one gets compliments often from the most unusual places, and my critics over my academic years used to refer to me as a freed maniac. I always appreciated the compliment. I'm not sure they intended it as such. But when I had the privilege of being at the University of Chicago in 1969, one of the most colorful things that we heard from Milton Friedman was that if you can't say anything bad about the Fed, don't say anything at all. I suspect I suspect, Mr. Chairman, you've observed that there are a few people that took that as a genuine dictum to be followed forever and ever. And I'm fascinated by that, and I wonder if, in fact, we don't have people who got so involved in the money matters controversy of the 60s and the 70s that they became convinced that the power of the Fed was in fact greater than it really indeed is. I mean, I hear people so glibly say the Fed must expand M2, the Fed must lower the interest rates, or the Fed must increase the interest rates. Now, the fact of the matter is the Fed has no authority, no power to directly increase or decrease the money supply, or nor directly to increase or decrease interest rates. Is that not correct?
Well, Congressman, obviously, to the extent that the money supply relates to the degree of reserves that are in the system, we can indirectly, grossly affect the money supply. We cannot affect it directly, as we cannot set it directly. We can, if we chose, fix the federal funds rate, that is the price of overnight money, since we have the monopoly on the supply of that product. In other words, we can create as much of that as we want or contract it. But having said that, that's about as far as we can go, because clearly that is the only instrument which directly relates to interest rates, and we only very indirectly affect the interest rates on private instruments or longer-term issues. So I would say I would agree with you partly, but only partly in that respect.
Well, first let me understand, I'm not disparaging the power and the importance of the Fed, but I do think we need to have it within context. And I recall during the late 60s and early 70s, I believe the chairman was William McChesney Martin, if I'm not mistaken, and used every instrument of the Fed to the most extreme ability, trying to combat inflation. And even though interest rates soared by recent standards, there just did not seem to be much of an impact on the expansion in the money supply, simply because the demand for borrowing, given the inflationary expectations, was so great that irrespective of how high the rates went, people were still rushing to get in now before it got worse later. And now in recent months, we all seem to be agreed that the Fed must expand the money supply and lower the rates. You are criticized by a great many people because you have not lowered the rates enough, and that you're in fact pulling on the string rather than trying to push on the string. And yet it seems to me that some of the things you cited in your testimony, which I was very pleased to see you mention with respect to examination standards and some of the regulators, have really diminished the willingness to supply on the part of the institutions, that in this case, irrespective of the potential demand, the institutional responsiveness is not there to your best efforts. Or should I join that gang that says the problem is really that the Fed isn't trying hard enough? Or should we look for some real explanation in the real behavior of the institutional players in the marketplace?
No, I think it's quite correct to start on the whole financial system and look at both supply and demand. The only thing that we can affect is the supply of certain financial variables in the system. That does have a profound effect on certain aspects of the financial system, but you are quite correct in the sense that there are many other forces which are at play over which we have very little control. We can endeavor to offset them, but not without consequences. And I think the crucial question is always, when confronted with very strong elements within the monetary or financial system, which we'd like to confront, at what expense, which is the real question often.
Thank you, Mr. Chairman. I'd like to come back later.
Senator Bryan.
Thank you very much, Mr. Chairman. Chairman Greenspan, as you know better than anyone, there's been a great deal of talk about the credit crunch. Some have suggested that it's more fanciful than real, but there have been at least some anecdotal reports recently that with the decline in rates that maybe lending has increased, traffic in real estate offices has increased, traffic in automobile showrooms has increased. That's, at this point, essentially anecdotal from what I'm able to understand. Can you share with us what the hard data that we have, what the impact has been of the reduction in rates? Have we actually seen additional lending on the part of major financial institutions that would address at least the perception of many that there is a real credit crunch in this country?
Yes, no, Senator, I think that you're raising an important question, and if you look at the weekly data, which we do in some detail on lending in various different categories, try to adjust it for technical changes in the structure of banks, we pick up a very small rise in lending in recent weeks. That is, we see it in part in the consumer area, we see it in real estate loans, very small. I would be very careful at this point to suggest, I'd be very careful in reading those data. I mean, it is very easy to take a few weeks and draw a trend and then find out then it basically turns down. All I can say to you is that the data are not inconsistent with those anecdotal reports, but it's really quite fragmentary at this stage, and I would be very cautious in reading very much into it.
I thank you for your answer. Are you satisfied, Mr. Greenspan, that there is, in fact, a credit crunch? You'll get a difference of opinion, as you know, on that issue. What's your own read?
Well, I think the reason why there is a lot of discussion of whether there is or there isn't is a question of what one means by that. And there are those who are concerned, who define it that individuals who are able to get credit under comparable conditions, say 2 or 3 years ago, are unable to do so now. That is an inappropriate definition because, in a sense, there has been a tightening of credit standards on the part of the commercial banking system, part of which I think is healthy, not something we should be concerned about. I do think, however, that we got to the point sometime during the summer of 1990 when we went over the line, if one could basically draw it, and credit was being deprived in a number of instances from otherwise creditworthy borrowers who, by any set of criteria, were good loan candidates and candidates which would be profitable to the commercial bank and generalized would enhance the franchise of the commercial bank. In a sense, I am saying that the commercial banker, the loan officer, are acting against their own long-term self-interests in that they are not basically looking at the fact that it is customers and relationships which create the franchise value of a depository institution.
There have been some pointing to the rather substantial declines that we've seen in values of commercial real estate in particular that say that this is a consequence of the change in 1986 of the tax treatment of real estate transactions. And a number of people have visited with, I'm sure, virtually every member of this committee, if not the entire Congress, that suggests that we ought to go back to those passive loss rules, among others, and if we did so, that we would see considerably more activity in terms of commercial real estate, that activity there would rebound. Also suggests that we might save a considerable amount of money in terms of this ongoing disaster that we face with the bailout of the savings and loan. Would you share your own views in terms of what the impact, if any, would be of those kind of changes if the Congress were of a mind to consider those changes?
I think the evaluation is partly correct in the sense that the 1981 Act created a degree of incentives within real estate, which in retrospect were deemed to be excessive and indeed were the basis of the changes in the rules in the 1986 Act. If one looks at the extraordinary expansion in commercial real estate that occurred in the 1980s, I think it's difficult to disagree that the earlier rules in part created a fairly dramatic expansion which had to come to an end at some point because we were creating more commercial properties than could be absorbed by the markets. When we reversed a lot of the incentives in the earlier act, in the 1986 Act, what we essentially did was to turn the markets very sharply, and one can see the timing of that having a dramatic effect on total commercial real estate. In my judgment, it would be a mistake to go back to the earlier rules. I think that it's a difficult period to go through, but I see no other way than to absorb the excess that exists in these markets. It's clearly having a negative effect more on financial institutions than it is on the economy as a whole. Or I should say, it's having its effect on the economy more through its effect on financial institutions than in the approximately 1% of the GNP which commercial construction is of total activity. But I don't see any reasonableness in some of the arguments that suggest we should reverse a number of the characteristics of the 1986 Act.
Thank you very much, Mr. Green. Thank you very much, Mr. Chairman. My time has expired.
Senator Smith?
Thank you, Mr. Chairman. Mr. Greenspan, I'd like to focus a little bit on this, following up on what Senator Bryan said about the capital crunch and credit crunch. In New England, although certainly credit is a problem with the New England region, I see it more as simply a lack of availability of capital. You do address it to some extent in your remarks, but I think the greater focus seems to be on credit crunch rather than capital crunch. Could you just comment on that, perhaps with a little bit of a tilt toward New England?
Yeah, I assume you're referring to capital. You mean the capital of the banks?
Right. Just
basically.
simply there just not being capital there. The banks apparently, at least the ones that I talk to, are trying to claw their way back to the ratios and just simply don't have the capital there, even for a good customer.
Yeah, I think that it's very difficult to distinguish between capital and credit crunch. It's the same process. What is happening on a day-by-day basis are commercial bankers who had been overly lax in lending standards, specifically on commercial real estate, in the mid-1980s, finding that the non-performing loans that occurred as a consequence are rising dramatically. Part of it gets written off, lowering their capital, and they continuously look at the asset side of their balance sheet and say that the quality of my loan portfolio is deteriorating. It's going to cut into my capital, and therefore the reason I'm pulling back is I'm fearful of capital. So it really is the same process, and I don't think much is gained by trying to differentiate it. It is obvious, however, especially in New England, that we could very significantly alter that credit crunch if we could wave a wand and add 6 or 7 percentage points to the capital asset ratios of a number of institutions. That's not feasible, and it's not a realistic way to go, but it does underscore that it really is capital which is at the root of the problem.
Okay, well, I see what you're saying. You're essentially putting, you're not using the terms identically, but it's in the same framework. So I understand your point. I don't need to dwell on it. Some have said, though, that some bankers tell me that the problem in New England may be the fact that if the market has to work itself out and the bad banks simply have to go under, mergers have to take place, and the market has to take its course. Some say that's the route that has to happen. I think some of that does have to happen. However, if in doing this, mergers take place and banks from other regions of the country, and I'm speaking strictly now about New England, were to come in and bring that capital in through a merger or an outright purchase with the approval of the FDIC, that's not going to help this particular region in New England if, in fact, those assets are then loaned out in other regions of the country.
Well, sure, it's obvious that I guess if you lend outside of the region in which the bank is located and you're picking up deposits locally and well, wherever the capital comes from, it's clear that those loans are not being made in the region. It's not helping the local enterprises. I might add that that's one of the reasons why I think that a number of the community banks have fairly potent competitive capabilities because they have the local knowledge and the local capabilities which a number of people who come in from out of state take a long time in gaining and are often somewhat surprised as to why they have such a tough time with all of their resources coming in and beating out what seems to be a small little operation in a local area.
I agree with that. And just one quick other point, Mr. Chairman. A gentleman by the name of Chris Gallagher of New Hampshire, he's a legislative counsel to the New Hampshire Bankers Association, made an interesting observation in a recent statement. I'd just like to ask your response to it. Monetary manipulation can't do the job any longer. Control by bank regulation is too painful, and growth locally or nationally won't lead us out of the woods. And he quotes Pogo saying, we have met the enemy and it is us. Essentially, we've produced this economic situation, we being, I suppose, the American people and the politicians whom they represent or supposed to represent, by producing huge debt, $3.5 trillion debt and $300 billion estimated deficit this year. This has got to be driving, this has got to be the engine driving some of the economic problems that we face today. Just comment on that. Are we flogging a dead horse? How in the world are we? How can monetary policy or any other policy by your agency or any other agency be able to deal with this situation as long as we keep driving the debt up and essentially the government moving further and further into competition with the private individual for borrowing money and credit?
Well, I think that was a very important argument as to why some form of sharp reduction in the federal deficit and hence in the federal borrowing requirements was so essential. I may not have agreed. In fact, I felt somewhat uncomfortable with some of the elements involved in the budget package that was struck late last year. But as best I can judge from observing the process which is enacted into law, it is going to significantly reduce the borrowing requirements of the federal government and hopefully unleash a goodly part of the private savings that is being absorbed in the federal deficit to be employed in more productive purposes in private investment, which will increase standards of living and productivity. So in that sense, I think that we're trying to come to grips with the problem that you raise, and hopefully successfully over the next several years. And that's, I might add, one of the reasons why I would be concerned if we began to see the budget package unravel and suggest that borrowing requirements by the federal government were going to escalate in an inordinate manner.
Thank you. Thank you, Mr. Chairman.
Congressman Solars?
Thank you very much, Mr. Chairman. You'll have to forgive me, my voice isn't up to par today. But, Mr. Chairman, do I understand your testimony, in effect, to be saying that there is, in effect, nothing the Congress either can do or, for that matter, should do to shorten the duration of the current recession?
Well, I think that a good deal of uncertainty was removed from the markets in the budget accord. I think that long-term interest rates were lowered, not a great amount, but enough to make a difference, and that has been, in my judgment, a contributing factor. I would be concerned if a number of, say, public works packages were introduced whose essential purpose was not to rebuild infrastructure for obvious other reasons, but as an economic measure, anti-cyclical measure. I would be concerned if we went in that direction.
Well, you made that point, but I interpreted your testimony to indicate that, in effect, you thought there really was nothing constructive or productive the Congress could do to shorten the duration of the recession. Is that, in fact, your view, or is there something you think we could do that would be helpful in that regard?
I would be inclined at this stage essentially to stand pat. Should it turn out that the evolving expectations, which are fairly broad at this stage, that the recession will bottom out, fails to occur, then I think it has to be rethought. But in today's context, I would say no.
Let's assume it didn't bottom out as quickly as we hope. Wouldn't the same arguments you've advanced against some kind of counter-cyclical package be equally applicable then, from the perspective of those who think it's inapplicable now?
Well, you mean, I'm talking about using fiscal policy as a counter-cyclical tool. If the economy starts to turn up, then I think it's pretty evident that further actions would be counterproductive.
But you think if it doesn't turn up or begins to further deteriorates, then it might be?
If the economy were to fail to stabilize and recover in the months ahead, it would be suggesting that there were other forces at play, and I think that that would clearly require an evaluation of by the Congress, by ourselves, and others.
Right. Now, you have a very carefully balanced, and I might even say hedged, prediction about what's likely to happen with the economy, and that, of course, is understandable. There are a range of possibilities. Could you share with us what might be characterized as your best case and your worst case scenario over the course of the next 1 or 2 years in terms of where the economy might be if everything worked out well on the upside, and where it might be if everything turned out for the worst on the downside?
Well, the number of scenarios that one can basically spin are innumerable, but I can give you representative ones. I mean, it's clear that the best case scenario is one in which the recovery begins in the next several months and starts up in a manner with inflation going down, as it sometimes does, but not too often, which would, in my judgment, support a fairly strong, long, extended recovery. The growth rate is difficult to judge, largely because we've had a slowdown in the rate of growth of our labor force. The rate of participation of women, which had been so dramatic a factor in the expansion of our labor force and growth, is now clearly slowing down. But I think if productivity picks up as we expect it will, I think we will have a fairly solid longer-term growth out of this business cycle.
What would be a sort of realistic worst-case scenario in the next year or two?
The worst case are very difficult to judge because so many things can go wrong, and what specifically goes wrong will determine what essentially the outcome is. But as I indicated to the chairman early on, I think the most likely concern is something that might occur from the financial system, from the fragility of the system, which I might say, however, is, as best I can judge, less fragile than it was, say, 6 months ago. But that's where the dangers would lie.
If I may ask one final question, could you possibly share your thoughts with us about the capacity of the country to effectively compete economically over the longer run with Japan, a unified Germany, and an increasingly integrated European economy? And how concerned are you about our capacity to do that in relationship to your concerns about the short-term economic problems we now confront?
No, I think that both Japan and Germany and in Europe generally have exhibited a really quite remarkable expansion in recent decades, especially coming from cultures which are rather old. That is, these are not the type of countries which you may recall during just before World War II, there was this concern about Europe being over the hill. In fact, there are lots of concerns that we were, and I think that's a mistake. I think we have extraordinary capabilities in this country. I do subscribe to the concerns of the Council of Economic Advisors on the issue of education, and that's as a crucial issue. But I think that our technical capabilities are really extraordinary, and the scale of this economy is such is that we have the possibilities of continuing to remain the major country, economic power in the world for as far out as I can envisage.
We're very pleased that Congressman Mfumi has joined the committee as a new member. We want to welcome him to the committee, and we look forward to his to the very positive contributions that I know will be coming on his part, and I'm pleased to recognize him. Now, I know you have a vote on, but until the vote absolutely calls you away, the time is yours.
Thank you. Thank you very much, Mr. Chairman. It is a delight to be a member of the committee, and a delight also to have the opportunity to talk to Mr. Greenspan again, which I seem to have been doing quite a bit these days. Mr. Greenspan, I want to go back, first of all, and thank you for your definition of capital availability as opposed to credit crunch. I happen to share your views that they are one and the same. A lot of it has grown out of the reluctance of banks to lend money, and that arises, I think, from attempts for them to bolster their own positions, or as you say on page 2 of your testimony, that banks are trying to raise capital asset ratios, or at least hold down declines in those ratios that come about as a result of bad loans. But like anything else, I think too much of something is bad. In this case, the issue of restraint seemingly has caught up with persons who could be most affected by that restraint. And I agree with you, tightening of credit standards is healthy. I wish that that sort of prudence had been exhibited over the years in a number of financial institutions in this country. Perhaps we would be in a different position now, but that not being the case, we're faced with a very difficult situation, particularly in the state of Maryland. I met this past week with the Maryland Association of Home Builders, and they essentially have said that their industry is in a coma, that building in the greater Baltimore area and in the Washington suburbs and indeed other parts of the state has come to a virtual standstill, and because of this credit crunch or this notion of no credit availability, that there are effects that spin off from that industry and the inability of that industry to continue. And obviously, it's the area of restraint, employment and jobs. And beyond that, the ability to buy supplies and materials, and that there are other industries that are affected. The tax base of states now are starting to feel, I think, to some extent, the effects of that. I would ask, as chairman of the Fed, if you would say something this morning, perhaps to the commercial banks of this nation, who, for their own reason, and I think in their own ways, have come to these decisions, this extra prudence that they seem to be exhibiting. But what would you say, as chairman of the Fed, that speaks to this issue and speaks to the need, I think, perhaps to move away from too much restraint and too much resistance as it relates to being able to lend and to make capital available for industries that are, as the home builders of Maryland indicate, in a virtual coma at this point?
Well, Congressman, I think that I would repeat what I said before, that what concerns me about this, what I consider inappropriate pulling back from lending, is not that somehow the commercial banker essentially owes a customer a loan. It's self-interest of the commercial banker if he is looking at the franchise value of his depository institution, which would dictate that he looks at these lending possibilities as a means by which his business will expand and flourish as distinct from pulling back. Commercial banking, by its very nature, is a risk-taking enterprise. I mean, in a sense, a commercial loan is an illiquid asset. It is by its nature, riskier. It is one which creates a higher degree of profit as a consequence, but that's the business that commercial banking is in. And when I say I'm concerned about the pulling back, I'm concerned in the sense that I think franchise values of a lot of institutions are being undercut, and I don't think that is good either for the owners of that institution, obviously. I don't think it's good for their communities as well.
How do you see us moving off of this deadlock or this dime that we seem to be stuck on? If the banks are taking this very prudent and conservative approach to these non-liquid loans, and yet there's an industry that their entire lifeblood is tied to the ability to get these loans.
I would think that the procedures that we've employed, which is one, bringing down the cost of funds to the banks, two, lowering reserve requirements, which has much the same effect, initiating a series of essentially clarifications in the way that examinations should be made are enough to unwind this particular process. But Congressman, as I've said previously, if it turns out that that is inadequate, we're going to do other things, and we're going to continue to push until we find the unraveling of the credit crunch evident.
Mr. Greenspan, my time is just about up. Before I leave to get over to the floor to vote, though, I want to go, if I can, back to page 12 of your testimony, where you indicate strongly that it's your position that voting to suspend the enforcement provisions of the Budget Reconciliation Act would be a mistake. I share that, and I've heard the rumors that are floating around that there may, in fact, be some idea to do something like that in particular areas. I think that would be a grave mistake. Equally so, however, you know, we had a great deal of rancor on the floor of the House yesterday as to whether or not and in what fashion we would move for this recapitalization of the RTC for $30 billion. And there was a great deal of resistance to the concept of pay-as-you-go, which was something that was built into the budget agreement. I was wondering if you had any thoughts on that at all.
Yes, I don't believe that this particular authorization should be pay-as-you-go. I think that first, a tax increase at this particular stage, for example, I think would be counterproductive to the economy, and it's very difficult for me to envisage an easy pairing on the expenditure side which would offset the amounts of money that are involved. But perhaps just as importantly, while the deficit is very important, there is something different about the effect of borrowing by the federal government to fill the hole in the savings and loan industry. There's something different from that process than borrowing to buy goods and services. The latter has a significant impact on savings and investment in the economy. The savings and loan funding does not. Its effect is much less on the economy. It has some, but it is much less than what was the run-of-the-mill budget deficits that we've had to finance over the years. So that as a consequence of both of those facts, I would think it would be inappropriate to try to fund this particular request from the administration. I think it's got to be made in that we have already guaranteed as a government these deposits, and it's only a means of resolving it, so that one way or another we have to do this.
I thank you very much for your answer, and Mr. Chairman, I would yield back the balance of my time.
Thank you very much. We again welcome you to the committee. Mr. Chairman, I have to say to you in all candor, as I've listened this morning, I've become increasingly concerned. I don't see how, when we've gone from an unemployment rate of 5.3% last July to 6.5% now in February, when we have these financial difficulties with the financial sector, that you in effect can simply sit there and say, well, we just have to stand pat. I mean, how deep do we have to get into this recession before we try to address it and stem its downturn? I come back to the question I put to you earlier about, you know, what risks are we running on the other side if we try to address it? Now, the Secretary of the Treasury said recently that there's plenty of room in the economy for lower interest rates. Do you agree with that?
I think there's certainly more now than there was a few months ago, but I would be cautious in making that sort of evaluation, because it is not clear that we are getting significant responses in the long end of the bond market, which is suggestive there's some resistance. Now, that resistance may in fact be nothing more than a general expectation throughout the market that the economy is about to turn. And in fact, as I indicate in my prepared remarks, I think that to the extent that we've seen a significant decline in the spreads of non-investment grade bonds relative to U.S. Treasuries, for example, that is suggestive of the fact that the market does anticipate the economy turning up. At this particular stage, moving against those types of expectations are not easy.
Well, here's my concern. We've done a staff study of the forecasts of the blue chip economic indicators at the time of the 81-82 recession. And you probably can't see this chart from there, but this solid line is how the unemployment rate actually moved. And in effect, it remains the top line throughout. These dotted lines that move across this way, well below the solid line, are what the consensus forecasters were predicting at every stage through that recession. So in effect, what happened is you had a bias, apparently, in the forecasting towards, if not short and shallow, at least not as deep and long as actually occurred. And then the question, of course, I think reasonable to ask off the basis of this experience is, are we, in effect, doing the same thing once again?
Well, Mr. Chairman, I think if you drew the chart going in the other direction, you'd find the same result. It's the tendency of forecasters to invariably underestimate the extent of declines in activity and recoveries. And if you were to draw the unemployment rate, say, first going up and then coming down, and you drew those forecast lines, you'd find that in most of the cycles that we look at, there is a tendency on the part of forecasters in both directions to underestimate the extent of the change.
Well, but that doesn't answer the question. I mean, that doesn't answer the point. The point is, even accepting that, then your policy decisions, if you're going to assert that position, your policy decisions, in effect, ought to compensate for this kind of prediction. In other words, what you're telling me is you're conceding, in effect, that the forecasters now may well be overly optimistic.
No, let me go further. You'll also find that as a group, they also miss the turning points. And I think that having observed this phenomenon now for many decades, you come to two conclusions. One, there is no alternative in monetary policy to make a forecast. I mean, I wish it were otherwise. There is no way to somehow say there must be some mechanical rule we could adhere to and that would solve all of our problems. I wish that were the case. It is not. Secondly, that the ability to forecast is really marginal in the sense that even though we get a big cluster of forecasters saying very much the same thing, we're all looking at the same data, the same evidence, and the fact of what the consensus is not always correct by any means. It does, however, tend to be correct more often than not. I mean, it's not a time course operation. Forecasting, probably using the appropriate tools, is right maybe 60% of the time.
Are you familiar? Sorry.
We have moved interest rates down really quite substantially, and the presumption that we are not responding, considering the fact that we've been moving down since the spring of 1989 as we saw inflationary pressures unravel, is in part a reflection of being aware of the type of chart that you exhibit, which we agree with. We think there is a tendency to underestimate.
All right, well, now let me just follow along then. Are you familiar with the article about a month ago in the Wall Street Journal by Alan Meltzer saying that the banks are not sitting on excess reserves, They are lending, investing, and adding the deposits and money as fast as the Federal Reserve permits. And he concludes, if the Fed supplied more reserves, none of the reserves would be held idle. Now, his assertion in that article is that while the interest rates have come down, you've not, in effect, put more money into the system. He says the Federal Reserve has been lagging behind the market, as it usually does at the start of a recession. Beguiled by the decline in rates, it believes that it has been easing, but quarter-point cut after quarter-point cut in short-term rates has failed to raise growth of reserves and money, a sure sign that the Fed is following the market down rather than boldly moving to limit the depth and duration of the recession. And then he has other figures about how much M2 has grown and so forth and so on to make his point. What's your response to that?
Well, let me just say first that one of the things that became clear when we were running into the credit crunch is that as we were pushing reserves into the system, they were not catching, so it just kept accelerating. And if you look at the numbers, I mean, first of all, in November, total reserves seasonally adjusted went up over 3%. In December, they were up more than 15%. And in January and February, they were up more than 6% and 8% in each of the 2 months. So what I think is fairly clear is that to whatever extent those reserves were lagging because of the credit crunch, we have driven them significantly higher. And the more relevant consideration, which I considered in Professor Meltzer's article, was the fact that M2 was lagging badly, and we were most concerned about that. And one of the reasons we started to move as aggressively as we did is to move M2 back into its target range, which we have succeeded in doing. And that, in our judgment, is one of the important things to make certain that there is no draining of liquidity from the system.
Well, having said that, what is your explanation then, simply put, for the concern over a credit crunch? I mean, there's a difference in perception. What we're hearing, of course, from constituents, and they, on an anecdotal basis, certainly demonstrate it, is that you have perfectly worthy borrowers, good projects and so forth, now finding themselves unable to get credit. You go over it with them very carefully as you hear these stories out, and, you know, in effect, they're making the point, and it seems to be a valid point. And they can show others who've looked at their situation and agree. There's no reason whatever why they ought not to be receiving credit and being able to move with economic activity. Now, why is that happening? I mean, if the banks have, according to you, sufficient liquidity, they have the reserves, interest rates are down, you have these borrowers wanting to incur loans, why are the lenders cutting them off? Now, I'm not talking about the ones you can look at and say, well, you used to get credit in a different set of circumstances and those circumstances don't apply anymore. I'm talking about the ones under any examination. As I understand your testimony today, you've conceded as much, that there are such credit-worthy borrowers who could carry out very worthwhile economic activity who are just not getting credit.
No, I think that what is involved is that banks are fearful that extending new loans for certain industries or for certain purposes will end up non-performing and cut into their capital base. And so long as they believe that, it is very difficult to induce them to lend. I mean, you can obviously increase their balance sheets. They will buy treasury bills, but you cannot make them pick up commercial loan or real estate loan unless they believe that it will be paid back and it will be profitable.
Well, now, they assert that the regulators are frightening them. And that these are the banks now. When you put it to them, they assert that the regulators are frightening them. They concede that there are some loans that they would ordinarily make, and they don't really see the risks that you're talking about. It looks like but that the regulators have them intimidated, that they have to meet higher capital standards under the international effort. Should that effort be slowed down, incidentally?
No, I certainly think not, Mr. Chairman.
And that, in effect, they find themselves frightened by what's coming to them from the regulators and, to some extent, from the Fed, who they see as essentially going with this general approach or attitude towards them. What's your response to that?
Well, I think I've heard innumerable anecdotal concerns about regulators, and I think that the stories are partially true. And, you know, in an odd way, I would be surprised if they weren't partially true, because we saw lax lending standards for real estate in the commercial banking area in the mid-1980s. We had examiners who essentially looked at those appraisals and said, that's fine. And when the loans became non-performing, both the loan officers and the examiners had a personally traumatic experience which induced them both to pull back. And I sense that we're seeing what is excessive in the way of pulling back on both the parts of the loan officers and on the parts of some examiners.
Well, how do we draw the line so it's not excessive in either direction?
No, I think
because we're in a downturn, unemployment is worsening, the economy is going in deeper into recession. There's some worthwhile economic activity out there to be done. There are people who assert they're prepared to do it. By any objective standard, they represent a good risk and ought to have access to credit. You're asserting that you're trying to make it possible for the banks to extend credit by increasing the money supply, lowering the interest rates, and yet nothing's happening at the far end. I don't think it's satisfactory for the Fed to sort of say, well, you know, we're doing these overall things, we're pumping in money supply. I won't argue now the extent to which you've done that and how far it may have fallen short, and I won't argue about whether the interest rates are being brought down quickly enough, whether there's, in fact, as Brady says, plenty of room for lower interest rates. But even with what you've done, you're not getting a response at the far end, at the grassroots level.
No, I think that that issue is something which has been of grave concern to us, namely that we have instituted a number of measures to essentially try to break the back of this credit crunch. I think, which, as I indicated earlier, there's some very early signs that something may be happening, but I think it's fragmentary, it's not conclusive, and I think we would be a mistake on our part to merely assume that that was the beginning of a resolution of the issue. But as I've said before, and I will repeat here this morning, Mr. Chairman, we will continue to move forward with additional instruments, if necessary, to make certain that that credit crunch problem, which is essentially the failure, one way of looking at it is the failure of monetary policy mechanism coming out the other side in the way of adequate loans to function. My judgment at this stage is that we may well have done enough to get it going, but unless and until we have confirmation of that, I think we have to continue to focus on other means.
Do you think the Fed should establish some process of interacting with the lenders and borrowers in a way that enables a focus to be placed on this issue and get the lines drawn in the right place? In other words, the Fed is doing things at this upper level. It's not being translated out at the grassroots level. Now, should the Fed, in effect, engage in a process of discussion and dialogue with the borrowers and the lenders out there that apparently are, in one way or another, frustrating the breakthrough that you want to see happen?
Well, Mr. Chairman, I think the first step which we took a week or so ago on indicating what we consider an appropriate approach to examination is clearly a step in that direction. I myself have been most concerned about the extent to which real estate appraisals, which by their very nature tend to be cyclical, have been employed inordinately for purposes of lending both on the upside and on the downside, and have created, in my judgment, a significant problem in bank examination and supervision. The rationalization of this process, I think, is important. I don't think it's a question of just merely looking at the downside. I think we have to look at the upside and the downside so far as examination is concerned. So far as the Federal Reserve or the other regulators getting directly involved in the process, I mean, we do have a considerable amount of supervisory interface, but one of the things I think would be most inappropriate for us to try to do is to actually get into the business of regulating the specific type of loans that are made. In other words, to basically directly or indirectly either get the central bank or the other regulatory agencies creating some form of credit allocation. What history tells us about that process is to stay away from it. So I think we can go up to a certain point, but be certain we don't go over the point, which becomes credit allocation, because the long-term consequences to this economy, I think, are clearly undesirable.
Let me ask you on the stand-pat view which you expressed towards any fiscal policy action by the Congress. Perhaps the most effective and certainly the quickest automatic stabilizer that we have is the unemployment insurance system. Amongst other things, of course, it ensures that the money goes to the area of greatest need, because by definition it goes to the unemployed. Now, that system is not working very well. The claims were excluded from the budget agreement last year as I think, a wise effort to put outside of the budget agreement framework changes that would come about because of downturns in economic conditions. So the claims are not offset against the spending caps, but there's not sufficient money to pay the administrative costs, which are associated with increased claims. The consequence of that is that unemployment insurance, which should be received within a week or 2 weeks after unemployment, in many parts of the country is being delayed 6 to 8 weeks. Well, that's a loss of purchasing power over that period of time. Employers have paid that money into a trust fund. There's more than enough money in the trust fund to meet the costs of the program, but it's not working the way it ought to be working. Now, don't you think we at least ought to make the unemployment insurance program work the way it's supposed to work?
Well, Mr. Chairman, what I was referring to in response to the question was basically a view of aggregative fiscal policy. I wasn't referring to actions that might or might not be taken in individual expenditure items, individual tax items, or in the mix that is possible under the budget agreement. it turns out that the administrative cost question is one that I suspect no one really thought was going to come up as an issue. I mean, obviously, there are cyclical characteristics in there, and I think the problem is what I assume the issue that you're raising is whether the category of administrative costs for the unemployment insurance system, which now, if it were increased, would require cuts in other programs, should be freed from that obligation. I assume that's what your concern is.
No, well, I'm raising two concerns. It's my own view that it should be, since it's logically consistent that if the claims are to be outside of the budget agreement, recognizing that they're the consequence of an economic downturn, that the administrative costs associated with processing those claims and make them available should also be outside of the budget agreement. But furthermore, in any event, those administrative costs ought to be available so you don't have this situation in the country where this automatic stabilizer is not able to work the way it's supposed to work. I think it's outrageous that people are unemployed, employers have paid in, they have to stand in line all day long, maybe come back the next day to file their claim, and then instead of getting it within 1 to 2 weeks, which is supposed to be the standard time period, they get it 4, 6, 8 weeks later. It causes incredible individual suffering, and of course in an overall sense it means that you're not putting that purchasing power into the economy at the very time that you seem to need it.
Yeah, I find that argument very difficult to go against.
The other question is, what about the whether we should address the trigger for the extended benefits? That trigger has been revised in a way that makes it very difficult to come in with a program for the additional 13 weeks of benefits after the first 26 weeks. Now, in fact, in some states, analysis has shown that the unemployment levels, because it's calculated different, it's calculated off of the unemployment insurance rate in a very complicated fashion, but that the unemployment rate in some states would have to go to 12 to 15% before the extended benefits would kick in. It seems to me that we need a reasonable figure for kicking in the extended benefits. Again, here's another automatic stabilizer. If, in fact, the recession is not short and shallow and continues on down, it seems to me you don't want, at the end of the 26 weeks, you would want to kick in with another 13 weeks of benefits. Do you have difficulty with that?
No, in fact, that was one of the issues to which I was implicitly responding earlier when I said that if the expected recovery, which everyone is beginning to focus on, fails to emerge and or the economy sinks lower, that sort of issue, I think, would be clearly an appropriate issue for the Congress to consider.
The trust funds for airports and highways have built up very large reserves in them. That money was paid in for a purpose. I mean, when the taxes upon which that rests were put into place, people were told, well, you're going to pay these taxes for these purposes. And on that basis, people assume the tax burden, were prepared to carry the tax burden. And over the years, we've maintained that linkage. It's the same sort of linkage that exists with the Social Security Trust Fund and the Social Security taxes, which also has built up a surplus and, in fact, is not contributing to the deficit but offsetting it. Now, what's happened is with this deficit pressure, as an accounting device, essentially, administrations have held balances in there, and then they use it to offset the deficit which is being incurred somewhere else. Of course, again, we're in a downturn. There's a general view that we are experiencing a third deficit problem, and that is the deficit in investment in our infrastructure. At a minimum, what would be wrong with working within the budget figures for the year, a faster spend out of that amount for the current fiscal year? Quicker movement on, say, transportation projects that are programmed to occur in any event over the course of 12 months in order to provide some early stimulus.
Well, Mr. Chairman, the difficulty that most economists, myself included, have with the process is that even though you can spin out the monies faster, if that were the decision of the Congress to do so, the timing between the actual construction operations and the stimulus to the economy invariably is quite delayed. And unless one were to presume that there is a very extended recession in front of us, which I think the evidence clearly is not supporting, you will end up with much of those activities beginning to emerge as the economy is accelerating. And if the purpose is countercyclical, it would be counterproductive. Obviously,
well, if they're going to emerge anyhow,
no,
if they're programmed to emerge anyhow over the course of the next 12 months, what is wrong with trying to move them as quickly as you can?
Well,
I'm not now talking about adding to what's programmed.
No.
I'm talking about speeding up what's programmed.
No, but they in fact would engender construction activity as a consequence of letting the funds. If it isn't, I mean, if it's the Congress's purpose to put a particular project on stream as an infrastructure issue or as an expenditure out of the various trust funds, and it is not stipulated as a counter-cyclical issue, that's a normal function of the budget. That's a normal budgetary outlay. The only concern that I have is the evidence suggests that when long-term projects, even those that seem to have a short fuse, are initiated, the vast majority of them come on as an economic stimulus well after the recovery is underway. And at least the theory of counter-cyclical fiscal policy in that respect would be violated. So unless you are willing to make the proposition that the economy is going to go lower or just stay down, I think it's difficult to support that particular activity as a counter-cyclical action.
Yeah, on the premise that it's going to be short and shallow, the recession.
But
If the recession isn't short and shallow, you may get some benefit by doing it, and in any event, you're not going to be doing something you wouldn't be doing within a fairly short time period anyhow.
No, that is a fair statement.
I'm back to the question I put to you earlier. Why can't we do at least some of these things that will give us some protection on the downside, and as I perceive it, carry with them very little cost on the other side? Help to give us some protection from the downturn and not contribute to some, I mean, these are going to happen anyhow. If it's short and shallow, these are going to happen, but they may not happen until next September.
You mean the actual construction process?
No, I mean letting it out, well, and getting it moving. Some of it can move fairly quickly, actually, because it's not as though you're talking about instituting an entire new program. In many instances, you're talking about continuing on and carrying through existing construction projects.
Yeah, let me suggest it's quite possible that if instead of talking in the abstract, we were talking about specific projects at specific times in specific areas, I might be less inclined to be concerned about it. Okay. It's just that it's difficult to generalize when the historic evidence, at least the weight of it, suggests that caution is required in doing this type of thing.
I have just a couple of questions about the Fed itself. Are you concerned by the fact that while the statute provides 14-year terms for members of the Federal Reserve Board, for yourself and your colleagues, and while historically members tended, if not to serve at least all of the term, some served all of it, and then even a second term, would serve substantial portions of that 14-year term, that it looks increasingly that members come on the Fed and stay for a few years and then leave the Fed, so that it's not really, they're not using whatever the purpose of the 14-year term was. Now, have circumstances changed so that we should not have a 14-year term, rethink the length of the term, or is something else amiss that results in members not staying for the full term or a good portion of the term, and is the Fed and the country the loser because of that?
I think there is a problem, Mr. Chairman, and it has disturbed me. I think the 14-year term was a sound judgment when the Federal Reserve Act was initiated. I think it's sound today for the same reasons. The people who have left, as best I can judge, have generally been confronted with a salary ceiling which in many instances created problems for them. In some cases, they are individuals who have children going to school and have increasingly felt incapable of maintaining the incomes that they perceive they need for their families, and have not been able to stay for the full terms. As a consequence of that, there tends to be, or will tend to be, a bias in the Federal Reserve Board for those who are independently wealthy, and I think that would be a very bad mistake. I don't know what the solution to this particular problem is, but it may well be that the increase in Federal Reserve Board governor salaries as of the first of this year may be a major contribution to helping to resolve this question. I certainly hope so.
There's been some movement on the salary front, hasn't there?
Yes, there has. There's been this. The salaries of the Federal Reserve Board have moved with the Congress's increase.
I think we should do this. How much do you think that's helped address the problem?
It's too soon to tell, but it is clearly significant enough to make a difference.
When does your term as chairman end?
In August of this year.
Do we have any indications what is going to happen?
I think it is much too soon to focus on that, and would not expect to see the issue focused upon until we get very much closer to the deadline.
The Fed, of course, is an independent institution. I mean, you get advice from lots of different sides, from the administration and from the Congress. And I think while we are often quick to offer advice and criticism. At the same time, we don't want to undercut or abridge the Federal Reserve, the independence of the Fed, or we recognize its importance in the operation of our system. Actually, Chairman Martin once said that it was intended the Federal Reserve should be independent and not responsible directly to the executive branch of the government, but should be accountable to the Congress. I'd like to think of a trustee relationship to see that the Treasury does not engage in the natural temptation to depreciate the currency or engage in practices which would harm the general welfare. What's your view on the current status of the independence of the Fed and the sort of pressures you're subjected to?
I think that we get pressures from time to time, but my general impression is that there is considerable respect for the need for central bank to be independent in this country. And while invariably we get lots of criticisms, lots of recommendations, and things which people call pressure, I think it's frankly a healthy process, which I in no way perceive as undercutting our independence or our capability of doing what we believe to be appropriate in the context of the oversight of the Congress.
Well, Mr. Chairman, let me make this observation. I was surprised in the State of the Union address when the President put forward the idea that you should be drawn into this capital gains issue. It's a highly controversial issue in the Congress, obviously, with strong partisan divisions. Actually, it is an issue on which you yourself have taken a position, as I understand it, in the past, a rather clear position. It's not clear to me how the involvement of the chairman of the Fed in that kind of role would square or be consistent with how we have traditionally regarded the role of the Federal Reserve Board.
Well, I think, Mr. Chairman, it comes out of special conditions that surrounded the Social Security Commission, in which, as you may recall, we had a major problem in 1982 with respect to the Social Security system, and a national commission was set up, and with some fairly sharp political differences with respect to positions taken by the various members. We eventually resolved a number of the issues because we were able to separate the value judgments, which were obviously the major issues, from the technical statistical issues, which we all were able to agree upon, and that made the ultimate conclusion, a resolution of the issue, easier.
Well, Mr. Chairman, as I recall, you weren't chairman of the Federal Reserve at that
No,
time.
no, no. I was chairman of that commission.
Well, I understand that, but you took that job as a private citizen.
Yes, no, but let me
The question here is whether the chairman of the Federal Reserve or the Federal Reserve is going to be drawn into this kind of an arena.
Well, I was merely trying to create some background to try to suggest where I think it's coming from.
That difference, it seems to me, is an essential one.
Oh, no, I don't say it's irrelevant. All I'm saying to you is that when requested by the President, joined by the bipartisan leadership of the Congress to assist in a technical evaluation of certain statistical data and evaluation and concepts, I frankly don't think it would be appropriate for me to decline. Now, I don't know how this will ultimately resolve itself. My own view of what the President was requesting is something similar to that technical issue, the technical statistical evaluation which took place in the Social Security Commission.
I take it you had agreed to undertake to do this?
In the context of the joining of the President with the bipartisan leadership of the Congress.
And you don't see that it's drawing the Federal Reserve into an arena in which it would be, given the role of the Fed, it would be wise for it to abstain?
I would say if we could do it and if we restricted it to certain technical issues which had nothing to do with the values, with the basic issues of one's view of capital gains, which is very largely a philosophical question, I would say that I see no difficulty in that area.
Well, I must say to you, it seems to me fraught with dangers for the Fed. I mean, I'm surprised that the chairman of the Fed would even consider being drawn into that sort of situation. I don't think it's advisable for the Fed or for the Fed's role in the workings of our economic system. Well, thank you very much for your testimony today. We appreciate this opportunity to have you back before the committee. Committee stands adjourned.